What's up, guys? Welcome to the Financial Dad Podcast. My name is Gus Robertson, and today we are going to talk about the potential for people buying homes over the next year. It's going to be crazy. It really is. I think that once the election happens and interest rates come down, you're going to see a ton of buyers enter the market. And I think there's been a lot of people sitting on the sidelines for the last year waiting to buy, which is not a very good move, and we'll get into why that is. I think that all that's got to happen is interest rates start to come down, and then again, you're going to see a ton of people enter the market. And so what do you need to be looking out for if you're going to be buying a home over the next, let's say, 1 year? There's two things that we're going to talk about today. Number one is know what your 48% is. And the second thing is know what your credit score is. And both of those need to be known before you even are even looking at a house. I think a lot of people make mistakes whenever they go and they're trying to buy a home, is that they get so excited about buying a house that they're unprepared whenever they go and they buy a house. And then they get taken advantage of. So what is your 48% number? It's a super easy number to calculate. Basically, you can just take your gross income, multiply it by 48%. And then divide that by 12. And so what that means, so as an example, let's just say you make $100,000 a year, and you multiply that by 48%, that's 48,000. You divide that by 12, and that is your monthly amount that the lender will max let you have as a monthly payment. Once you multiply that out, then you know that number. You don't have to have anybody tell you that number. You know that number is $4,000 a month. That's $48,000. That is the max that a lender will let you borrow to buy a house if you don't have any other debts. So that number is super key in your ability to buy a home. And then what do you subtract from that number? So what you do is you take the 4,000, you basically, if you wanted to, you can go on any credit bureau, but a lot of people use Credit Karma. It's free. So you can go on Credit Karma, and whatever is showing up as payments on your credit, you have to subtract those out from that 4,000. So if you have a car payment that's $1,000 or $500, let's say a $500 car payment, that comes off of the 4,000. If you have any other bills, even credit cards, so, a lot of my clients will have, let's say, 5 credit cards, and let's just say you have a zero balance. You still have to take off $25. There's a minimum payment that they will have for even a zero balance credit card, because you can always charge it. And so it's usually $25. And so once you subtract all of those out, so car payments, any other revolving payments that you have, then let's just say that you get down to that number and it's $3,000. So the bank will let you borrow up to $3,000 to buy a house. And that is your 48% number. The issue that I find is that a lot of people max out. They get so excited about buying a house, and they're not rational in regards to that. There's a lot more that comes into home ownership than just paying a house payment. And I think that that's where a lot of people mess up, especially first-time home buyers, is they go out, they max out to $3,000, and they really, because nobody ever even talked to them. Like for my kids, what I'm going to do is I'm going to say, hey, listen, you need to bring that number down, and because home ownership comes with furniture. Home ownership comes with things have to be fixed that when you were renting, you didn't have to pay for it. Or when you were at home, you didn't see those things. And so those things need to be talked about. And this is because it's a Financial Dad podcast. I think it's important for parents to, especially their kids are coming into the market to buy a home, or even if you're a first-time home buyer, to know what are the unexpected or unseen expenses of home ownership that you don't have whenever you're renting. So let's go back to the 4,000. So once you subtracted out all of those expenses that you already have, again, car payment, credit card payments, School loans are huge right now. All of those have to be taken off of that $4,000 number. And then that will leave you with what you can spend on the purchase of a home. Where I see a lot of people make mistakes is that they go and they max out that $3,000 payment. That's the number one thing. They're not rational about their purchasing, and I think that if you establish a number up front and you stick to that number, and then you know that number before you ever go talk to it. You do not need to go to the bank and let the bank tell you the amount of house that you can buy. So that's what the bank's going to do. They're going to take those numbers. They're going to look at the same numbers that you can look at before you ever even go to a bank. And they're going to say, okay, well, your number is 3,000 based on the interest rates right now. Then this is the max house that you can buy. You are pre-qualified for this amount of purchase. But just because the bank tells you that you can do that makes no sense that you would go max that number out. That's not a very good move, because it takes a whole lot more to own a home than just making that house payment. And I tell all of my clients that making your house payment is the easiest part of home ownership. It's the easiest part. It's everything else that just comes out of, now you got to fix the commode. Now you got to fix the lights. Now you got to buy blinds and furniture, and all of these things just pile up. And then home ownership is not as fun as you thought it was going to be. So there is that. So now let's talk about what your potential house payment could be. It's called a PITI payment. So that's principal, interest, taxes, and insurance. And I get it, there are other things that can be added into that, but the foundation is your PITI payment. Again, principal, interest, taxes, and insurance. And so when you're figuring out your principal and interest, that's a simple financial calculator. If you go to the bank and and the bank says you can borrow up to $3,000, and let's just say you put that in a financial calculator and you're like, oh, okay, well, I can buy a $300,000 house. So now it'll give you the principal and interest. Now you can figure out the taxes. The taxes are known. If it's a home that is already established, meaning you're not building it, then you can call the tax department of that county. You do not have to have a bank to tell you this. You can call the tax department of that county and they'll tell you how much the taxes are. Just divide that number by 12. There's your taxes part of your PITI payment. Insurance. You can call your insurance person and they will tell you what the insurance is on that property. You don't have to have a bank tell you that. So now you know what the principal, the interest, the taxes, and the insurance are. So now you are well prepared for no matter what house you're looking at, you know how to calculate those numbers, and now you are in the know. You don't have to have a bank tell you that. And yes, I get it. There are other numbers that can be added into that, and we're basing off of a full 100% loan value. Not many banks are going to let you borrow 100%, but again, this is just baseline, just figuring out some baseline numbers. Of course, you could put down a down payment. You could have the seller that puts money towards the purchase, or your closing costs, all that kind of good stuff. But again, that has nothing to do with just figuring out baseline numbers. This is you as the buyer being well informed before you ever even look at a house. So again, any simple financial calculator can do that. Again, a phone call to your county to figure out what your taxes are, as well as your insurance provider, and figure out what your insurance would be. Now you're in the know. So let's go back to that. Simple numbers. And let's just say that you were buying a $250,000 house, and at 6.89% interest, which is now on a 30-year note. I'm not saying that people should do 30-year notes or 15. This is just for context. So your principal and interest payment is around $1,645. $1,645 on a $250,000 house. And then you add in the taxes and insurance. And again, let's just say that taxes and insurance are $250. So now you're looking at a $1,900 payment on a $250,000 purchase. And yes, again, a little side note, this is not taking into consideration PMI or if you had to have flood insurance, or if you bought a condo and you have association. This is just a straight, just bare baseline numbers. And so now you have a $1,900 payment. So you can work backwards on that $1,900 and figure out what does that make up of your gross pay. And so I think that it's very misleading whenever people think about that. I think they get so focused on the purchase of the home that they don't understand that what portion of their income that $1,900 purchase is going to make up. And so I think that financially, that's where a lot of people mess themselves up, because again, it takes a whole lot more than just making a house payment to own a home. And I'll go back and say this: you don't have to max out to $3,000. You just don't have to do it. That's the number one issue where I see is people get so excited about buying a home that they exhaust the $3,000 out, and then they don't have any money to actually just live and have a good time. Purchasing a home is supposed to be a good, positive thing that we're doing for ourselves or for our family. But you don't want it to constrict your ability to just live. And I think that's where I see a lot of people doing it today is they buy too much house. And when interest rates were lower, man, that is the biggest mistake that I saw whenever interest rates were 2%, 3%, 4%. People were maxing out and buying way too much house because that home has to be maintained. And you don't have to do that. It just needs to be well thought out. And remember this: once you signed a dotted line on the purchase of a home, the bank could care less what your other expenses are. All the bank cares about is that you owe them money. You owe them a payment on the first of the month. On the first of the month. And if you make that payment, then they're your best friend. If you don't make that payment, then that's going to be a problem. They don't care about any other expenses that you have. So you have to think about, if you're entering the market over the next year, just work backwards. And again, you don't have to go and talk to a lender to do this. If you have any questions about this, you can drop a comment or a direct message, and I can walk you through very simple solutions on how you can help yourself. Super simple. Next thing is credit score. You have a lot of influencers right now that are so cash heavy, or they talk about, oh, well, you don't need a credit score. I love Dave Ramsey, but when he talks about borrowing money, oh, well, you don't need credit. That's great if you have enough money. But if you don't have enough money and you're first starting out, especially what parents can do for their kids, or parents or anybody can do for themselves, you have to protect your credit score like it's your job. You really do, because that is the very first thing that the bank looks at. Before they look at how much money you make, the very first thing they're going to do is get your Social Security number. They're going to pull your credit. And the reason why they're doing that is because it is a snapshot. It is a picture of your ability to pay back your loans. If they pull your credit and you have a history of past lates or not paying at all, or if you have a huge amount of debts where you're just paying the minimum payment and you just keep charging, that's how you're going to pay your mortgage payment. And the banks do not want to do business with people like that all the time. They will do business with people like that, but your interest rate is going to be, quite a bit higher. And the goal when you're buying a home is to put yourself in the best position, meaning that you don't want to pay a higher interest rate. You don't want to be penalized for mistakes that once you watch this podcast, hey, that's a mistake. I shouldn't do that. And so what affects your credit? Number one, in a positive way, having debts and paying back those debts, let's say after 3 to 6 months, it's going to start to positively affect your credit, meaning your credit score will move up. Doing things like not paying back your debts, not paying on time, having a bunch of debts, meaning like if you have multiple cars, motorcycle, credit cards, school loans, and you're exhausting 100% of your income, meaning like, okay, I make $5,000 a month, I'm spending $5,000 a month, or I'm spending, let's say, 75% of that on paying back debt, you're not going to be buying a home. You will, I mean, just straight facts. You will not be buying a house if you spend everything that you make. And then, because that's going to show up on your credit score. Your gross income, your debts will be taken off of that monthly amount of money, which makes up 48%. They leave you the other 52% to live off of, which I've got a problem with that too. I mean, it's a ridiculous thing. Nobody in today's world is really able, especially if you're first starting out, is able to just live off of 52% of what they bring home. It's rare. It's very rare. But because everything is going up, all expenses are going up. So that's why you have to be really, really cautious about looking at the 48% and then spending that 48% on everything that has a payment. And again, that could be medical bills, car payment, house payment, credit card payments. Everything is in that 48%. So you have to be very careful. If your credit is not great, meaning that I think the number is around 650 right now. If you don't have a credit score of 650 and above, there are very simple things that you can do to get your credit score above. And if you've made mistakes, which we all have, if you've made mistakes on your credit and you have some things that need to be cleaned up, it's very simple to clean your credit up. It just takes a little bit of time to do it, a little bit of time and effort, and you can clean your own credit up. You don't have to go pay $1,000 to somebody unless you just don't want to do it. You don't have to go pay $1,000 to somebody to have them help you clean your credit up. You can do it. And maybe on a future episode, and I will do some quick things on how to clean your credit up. But you want to keep your credit in good standing at all times, because that means that you're going to get a better interest rate on your home. You're going to qualify better, and you'll be able to get that house that you're trying to buy. Thank you guys for watching the Financial Dad podcast today. I hope this helped. Again, the two things that you want to know if you're going to be entering the home buying market over the next year is, number one, know what that 48% number is. It's key to your ability to know where you financially stand. And number two, protect your credit. That's the biggest thing. The credit is the very first thing that lending institutions look at whenever you're trying to buy a home. Straight facts. And so thank you guys for watching the Financial Dad podcast today. If you have any questions, just comment or send us an email at financialdadpodcast@gmail.com. Talk to you guys later.